Welcome to today's webinar. I'm Jeff Richardson, Senior Vice President of Marketing at VantageScore, and I'll be your host today. Today's webinar is entitled How Credit Score Competition is Reshaping the Mortgage Market. This is actually the second in a series of our monthly webinars. Thank you for those who are joining for the first time. Thank you for those who are rejoining after participating in last month's webinar. To recap last month's webinar, it came fresh off the announcement from FHFA that VantageScore 4.0 was approved effective immediately. And we talked about what that decision means and how to begin to use VantageScore 4.0 scores in your business processes moving forward. Today, we're in a different phase, a phase that's characterized by a lot of momentum, pushing the GSEs to make decisions and make rules public. And we're also at a point where it's important that VantageScore and lenders can articulate the business case for using VantageScore 4.0. And so we built the agenda for today's webinar with those concepts in mind. As you can see by the slide in front of you, the first thing that we're going to cover is an insider's look at how Congress are really pushing for the advanced implementation of VantageScore 4.0 and how they're supporting this effort in very visual and noticeable ways. We'll also talk a little bit about VantageScore's performance. And it's not just VantageScore's own analysis. We thought we'd dig deeper into third-party analysis that's examined the VantageScore model's performance. Things are moving very rapidly, right? And so we want to make sure that anytime there are updates, we're sharing it with you as soon as we can. So this will be a long-standing agenda item, questions and implementation hurdles, what questions have been answered, what are still to come. And then we'll talk about VantageScore's market gain analysis. This is an analysis that's custom made to a lender's portfolio and footprint that helps identify the incremental loan volume and opportunity afforded once VantageScore 4.0 is used. And so we'll be investigating what those reports look like and how to request them. So this is today's agenda. Before we go to the next slide, I just want to mention there is a Q&A function in the Zoom menu there at the bottom. Please use that to submit questions. Don't use the chat. And please do stick around towards the end and fill out the feedback survey. It's just one question ranking the webinar's relevance, 1 to 4, 4 being most relevant. So please do, we value your feedback. To the next slide, please. So joining us today will be Tony Hutchinson, who was with us last month as well. Tony is Executive Vice President and Head of Public Affairs for VantageScore. He is our man in DC. He has over 30 years of housing policy and government affairs experience. He worked at pretty much all of the GSEs at this point, and we really value his insights and front row seat to what's happening in Washington. Also, we'll be joined by Atif Mirza, my colleague at VantageScore, Senior Vice President, Head of Credit Insights. If you've been on our website, you've probably used our tools Inclusion 360, Credit Gauge, Risk Ratio, and the tool I just mentioned, Market Gain. Atif is the executive behind these programs and these tools, and so we're really pleased to have him. He brings to VantageScore over 20 years of data strategy and analytics experience, having spent time at firms such as Goldman Sachs and other major financial services companies we all know very well. Tony, Atif, thank you for joining us today.
Hey, thanks for having me, Jeff.
Thank you for having me, Jeff.
Okay, so without further ado, let's get into the first agenda item, and I will pass the webinar over to Tony. Over to you, Tony.
Hey, thanks, Jeff. And everybody, thank you for joining us this afternoon. It's great to have you. There's a ton of changes occurring in the mortgage marketplace, as I know that you all are all aware. But the way we wanted to structure this is I want to talk you through, one, what's going on in an administrative position within the market. Then take a look at what some of the industry players are saying about this change. And then we'll finish up with, at least for this section, with what's going on in Congress. And to Jeff's point earlier, there is a ton of momentum pushing forward to have the new credit score model, in particular VantageScore, utilized in the conventional conforming space. We're going to start with where everything started, coming out of FHFA. So we all know that on July 8th, Director Pulte indicated that VantageScore 4.0 was approved for utilization by Fannie Mae and Freddie Mac immediately, effective immediately. Of course, that meant that the GSEs were going to have to get some of their systems up to speed. And the one thing that everybody should know, even though there has not been a lot of conversation or notification about this, FHFA is really driving the GSEs to get this done in relative short order. Director Pulte just at the beginning of this month tweeted again that the GSEs are working frantically to get us implemented so that more folks have an opportunity to utilize VantageScore 4.0, and they'd like to see that done this year. So there is a lot of pressure on the GSEs to get the information that you need out in the marketplace. The director is going to continue to make these assertions so that, in a way, he's signaling to the industry that this is coming. He wants you to be prepared. So no longer sit back on your laurels and just wait to get things done. He's indicating that the GSEs are moving forward, full steam ahead, working as fast as they can. And we want you all to be ready when the GSEs say today is day one to utilize VantageScore 4.0. And he's reiterated in public why this is important. It's important because we score more folks. The administration wants to do as much as it possibly can to improve affordability for housing for consumers and to get as many people on the path to homeownership as possible. So they want to utilize scores that allow that score the majority of people in the marketplace, and not just scores more people, but performs a lot better. So that the GSEs, Fannie Mae and Freddie Mac, will be on a firmer, safe, and sound footing going forward. Coming out of the Great Recession, that was one of the questions that everybody had wanted answered. How are you going to do this? The GSEs, along with FHFA and prior administrations, have worked really hard to improve the GSEs and have done so. One of the last frontiers is upgrading the credit score models, and that's what they're doing now. The other piece there, and this is something that the director and a lot of industry participants continue to hone in on, is if you can pay your rent, it is most likely that you can meet today's mortgages. And why is that? Because we've seen almost a confluence where rental payments tend to be a bit higher, if not equal to, if not a bit higher than mortgages. So it's a very good predictor. So one of the things that our score does is when rental payments are in the credit report, we take that into consideration. So we're currently working to make sure we can get as much of that rental information in as possible. And you'll know that both the GSEs are also trying to find ways to get more rental information into the analysis so that they can better establish credit worthiness for potential homeowners, because it is a key indicator. So that is something that the administration has honed in on and is pushing. And that's why you're going to see them work as quickly as possible to get us implemented in the mortgage marketplace. Now, I mentioned that there are folks out there outside of the administration that are really driving for this adoption. And we've just highlighted a few here. The Community Home Lenders of America, credit union groups, all folks who are really trying to drive home ownership across the country, specifically in smaller communities, want to ensure that the vast majority of consumers in those markets, specifically those who have not been scored to this point, are scored and can see where they are on this path to home ownership. The one thing that we try to reiterate with everyone out there is that just because we score you, and we'll get to this when I talk about the data in a bit, doesn't mean you're going to have a score that's going to make you credit worthy for mortgages. In fact, 2/3 of the people that we do score don't, but there is 1/3 of that group, 13 million of the 33 million more consumers that we score than the classic score in the marketplace, have a score that would make them eligible right now for a conventional conforming mortgage. That will drive a lot of demand. Now, it doesn't solve for the shortage in actual physical properties out there, but it does solve for one of those issues that we've been looking at over the better part of the last 20 years. How do we get more people in the pipeline that are credit worthy to be able to purchase housing and participate in home ownership in the United States? So we have industry support that is really beginning to grow. And these are just a few examples. But where the real rubber meets the road outside of the administration is in Congress. Right now, Congress is really focused on trying to find ways to make consumer goods affordable. Uh, One of the ways that they see this is by making sure that everyone, specifically in the mortgage market, everyone has a credit score so that the consumer can, but for themselves, determine how they want to participate. They no longer want to see people who don't have a score beholden to financial institutions to just give them a high rate, which makes things affordable. With VantageScore 4.0, the majority of people out there will now have a score and they can make a decision for themselves. Do I participate in the financial market with the score that I have, or do I stand out so I can improve it? And if I do participate, because our score is more predictive, now these folks are going to get better pricing down the line. Congress sees the value in that, so much so that 23 of 30 House Financial Service Committee Republicans signed a letter thanking Director Pulte for moving forward and driving the use of the new credit score model and our, in particular, VantageScore in the marketplace. And these folks are not alone. It's not just Republicans who are looking to this. We've had bipartisan support for this effort for years. In fact, the legislation that drove this was a bipartisan effort by Senators Tim Scott and Mark Warner. Senator Tim Scott, as you know, is the chairman of the Senate Banking Committee. But again, it's not just one-sided. We have a group of folks here who got up in front of the Federal Home Loan Banks during their conference in Washington, D.C., and thanked the banks, specifically in their markets, that had already adopted VantageScore 4.0 for pledged mortgage collateral. So right now, there are a number of you out there who can utilize VantageScore 4.0, especially if you want to pledge mortgage collateral to one of the federal home loan banks out there that's already accepting VantageScore. But that was a big deal. And these members of Congress specifically wanted to thank their members because it gives their constituents a head start on some level of affordability in those marketplaces. And just as an FYI, the federal home loan banks that currently accept VantageScore for pledged collateral are Chicago, Cincinnati, Dallas, New York, and San Francisco. So a number of folks pushing for this, and the momentum continues. They're not backing down. They want to see this get across the finish line. Now, key is we can talk all day long about how we're a better performer in the marketplace than the classic score, and we can always talk about how we score more people. But the real rubber that meets the road, if I can use that again, is when third parties actually conduct analysis and then make their opinions known. So there are 4 parties over the last year that have conducted analysis on the historical data set that was released by Fannie Mae and Freddie Mac with Vantage scores appended to it, so that the marketplace would have an idea of how the score, VantageScore 4.0, performed versus the current score in the marketplace. The more current report that's came out from Bloomberg Intelligence. It is a subscriber-based only report. So if you are a subscriber to Bloomberg Intelligence, I would suggest that you go there. But the key to get from this is that they took a look at our score during the stress period that occurred during the time of the pandemic. Credit score modelers continue to talk about how they need to understand how scores will work during stress. Well, Bloomberg did that and effectively said that when they took a look at the score during the 2019 period, they saw that VantageScore performed 15% better predicting defaults during the pandemic than the classic score in the marketplace. That's significant. A lot of that has to do with what we utilize with this product versus the classic score. Trended data is the key. Now we're looking at people over a 24-month period to predict a 24-month period of delinquencies. And the model and all of the inputs that we use are extremely predictive, and Bloomberg Intelligence called that out. Aside from that, they saw that there was a separation between how our score, a significant separation between how our score performed and the classic score performed. So again, during this period of stress, the new model with the new inputs was out there outperforming the existing model. That means a lot. That means that the GSEs, when they get these mortgages, are going to have a better idea of how they're going to perform. So they're going to be more safe and sound in their operations. When I get to one of the later slides, it also means that there's a benefit for the consumer out there in terms of their pricing. KBRA, which is a ratings agency, also did an analysis of that same historical data set. They did one back in July of 2024, and then this was a recent update. Effectively, what they're saying is, and this is an argument that people have always talked about this. They think that VantageScore is only going to score better the folks at the lower end of the credit score range, specifically of the prime range, thinking that we were going to score people better from 300 to 620. We do score those folks very well, but we score people extremely well throughout all tranches. KBRA found that that mid-range was really the sweet spot for us. And that's important because the folks that are scored there, many of which currently have mortgages in the conventional conforming space, may be able to adjust their score and get better pricing. And more important, the people coming in now will get better pricing. So that's something that we want to see. They also called out the fact that it was the trended data and the additional data collection that we have in our model that really showed strength for us. And then we'll harken back to just a couple of the older reports that were out there by Bank of America and then followed by JP Morgan Chase that occurred last year when the data set came out. The work that they did here was focused on, one, how the new scores compare to the classic score, but then they also did a scenario there where they were looking at the buy merge. One of the things I'll tell you is we're agnostic to how the score is utilized in any of the merge situations, but I'm going to focus on just the current tri-merge situation. Effectively, they said that utilizing our score, when they took a look at that data set from 2013 to 2023, that VantageScore predicted better prepayment speeds. So again, that allows the enterprises to have a better idea of how they're going to have to hedge against their portfolio. It also allows a lot of you who have portfolios to better understand how you're going to need to hedge and how you're going to need to prepare for some of these mortgages that'll move out of your portfolio. And then finally, JP Morgan Chase just simply said that our score was better at predicting delinquencies. And I know that you'll sit there and go, well, a 2 to 4% delinquency lift is not much. But when you're dealing with hundreds of millions, if not trillions of dollars of business, that is very significant. And it's very significant not just for the mortgage market, but for the GSEs in general. So that just gives you a small snapshot. I'd encourage you all to reach out to Bank of America Securities, JP Morgan Chase Securities, KBRA, and Bloomberg Intelligence about their full reports so that you can get a readout on them. We cannot distribute those to you, but you can go to them. I think it's very well worth the read, specifically if you are a modeler. I'm going to quickly finish up so we can spend the remaining time on market gain and just let you know that right now is a good time for you to reach out to your credit score provider, whoever is providing that, and find out if they can deliver to you a VantageScore 4.0. If they can, that's great. Then go to your LOS and make sure that they are either able to do it right now or are working to get that done in short order because, like I said at the beginning, FHFA is working feverishly to get the rules out so that you can start using VantageScore really, really soon. If both of those things are positive for you, then I would say that the best thing for you to do is bring in the score right now at origination to mirror the score that is currently in the marketplace. So you have a better idea of how consumers in your marketplace are going to be improved, and in some instances, maybe not improved by the utilization of our score, but you need to understand that performance. If you have a portfolio, it's easy enough to then be able to reach out to your credit score provider and have our score appended so that you can do your analysis, your back testing to see what a VantageScore looks like for your current portfolio and help you begin to understand how you can move forward with different loss mitigation strategies and capital requirement strategies. And then finally, again, if you are able to get the scores in via your LOS, use VantageScore for non-QM, VA, or pledge collateral with the Federal Home Loan Banks. That's going to get you really up to speed for when the conventional conforming space is ready to go live. With that, I'm going to pass it over and so for our remaining time to Atif, who will talk about our market gain reports. Take it away, Atif.
Thank you, Tony. So my name is Atif Mirza. I am Senior Vice President and Head of Credit Insights at VantageScore. So today I'm going to talk about a market gain that supplement nicely what Tony talked about. Next slide, please. So today I'm going to talk about three things. What is market gain? A brief walkthrough of a sample report, a market gain, and how to request a market gain report. Next slide, please. So first thing I want to say is that it's totally free, no cost to lenders or consumers, and you can request this analysis through our website. But what is market gain? Market gain is a leading edge analysis that we created to provide data and insights for you lenders and fintechs regarding how your specific addressable market can increase by implementing VantageScore 4.0. This analysis is based on newly scoreable population that VantageScore 4.0 can score compared to the conventional models. Now, we created two views of market gain. First was a non-mortgage view that included 7 products: retail card, bank card, home equity, auto loan, personal installments. However, with this new announcement, we created a mortgage view that specifically talks about first mortgage, HELOC, home equity line of credit, and home equity line of home equity loans. Next slide, please. So here is the sample report. Market gain itself is a 22-page report. It's a PDF file that once you request, we create and send it off back to you guys. But it starts with an executive summary that talks about what is the newly lendable consumers that you can achieve by converting to VantageScore 4.0. What's that percentage wise uplift is, and then what is the dollar potential opportunity that is associated with the new population that you will see with VantageScore 4.0. So this is another page that describes the overview by products. So for example, in this here, we're doing first mortgage, HELOC, and HELOan. And what I want to tell you guys is that we focus on the lendable population, which we consider between 600 to 700 VantageScore credit scores. So the report, the 22-page report, goes through by products, individual product views. It does show top counties, top 5 counties where your footprint is, and then it also talks about the score bands. So specifically 20-point band intervals, 600 to 620, 620 to 640, so on up to 700. And what we actually show is if you go back to previous slide, please. We also show the loan counts. So just to give you a little bit of logic, how we create this report is that we go down to the zip code level. We look at the FDIC branch location data, and in the case of credit unions, we look at the NCUA branch location data, and we go down to the zip code and see existing population that is scored by the conventional models. Now, what that population is between 600 to 700, and then we apply VantageScore 4.0, and we say that, what is that additional population that we are able to score? And looking at the existing population's loan profiles, we apply that approximation to the newly populated borrowers with VantageScore 4.0, and we plot that opportunity for you. So it's a very detailed report. I'm going to talk about how to request this report now. Again, like I said, it's no cost to lenders. It's ad hoc PDF report that we'll generate. And normal on any given Wednesday, it's a 2 business day ETA. But I know that after this webinar, a lot of you guys will be requesting it. So it might be a little bit more than 2 business days when we deliver this report back to you, but we'll try our best to do it within the 2 business days. How to actually request it is very simple. You go on our website, VantageScore.com. On the very top menu bar, you'll see our insights, and then you'll see these 4 tools that Jeff initially mentioned. But market gain is the bottom on the bottom of the list. You click on that and scroll down on the page, and you'll see 2 options. If you were a credit bureau a member, a person from the credit bureau, you have your own CRC portal on the right-hand side of the bottom left box. You can click on that and go to the CRC portal and request it within that portal. And if you are a financial institution and you do not have a CRC contact person, you can directly contact us. Click on the button, and there'll be a request form that'll open up. Just simply fill out that information with your first name, last name, email, and you know what exactly you're looking for, and the request will come to us, and then we'll send it back to you within the 2 business days. So with that, I'll turn back to Jeff.
Thank you, Atif. Thank you, Tony. And congratulations on landing the plane within the allotted time. We like this 30-minute format. We think it works for our stakeholders as well. So we have a couple of minutes, literally, to answer some questions. Anything we don't get to, we'll be sending out a second email along with the slides with the answers to those questions to the extent that we have them. Tony, we have seen performance against FICO Classic. How can we see performance against the 10T?
Unfortunately, we can't see performance against 10T. One, we don't have access to 10T, just like the industry does not have access to 10T. One of the things that we're hoping is that our competitor will release that data similar to the data set that we released in July of 2024, so that level of analysis can be conducted. But right now, the only analysis that anybody in the marketplace can do is versus the classic score, because we have access to that, and now you have access to VantageScore.
Thank you. Question over to Atif. And again, there's a lot of questions coming in. We won't be able to get to all of them. To Atif, we're a small mortgage lender. Is a market gain report good for us, and how do we sort of demonstrate our footprint to you?
So, like I said, we designed the market gain. If you were listed in as part of the FDIC branch location, we pull your information through that. Or if you're a credit union, we go to the NCUA database. But if you're a fintech or a very small footprint, we do have an ability to prepare a report at a state level. So let's say you only operate in Florida, so we can create that report at a state level and show you the top county and the opportunity within that state. And this is how you'll be able to see, and you can request for any state basically, and we can provide that analysis to you.
Awesome. So market gain reports are relevant to all lenders and fintechs that are participating in this webinar. That is going to be it for today's webinar. Tony, if you could advance to the last slide. I just want to call everyone's attention to these QR codes. The most important thing you can do is to follow up with us. We are able to refer you to the 3 credit reporting companies, Equifax, Experian, and TransUnion, so that you can get started accessing VantageScore 4.0 scores and using them in your business processes. We also have a mortgage resource migration playbook. You can see the middle QR code is appropriate for that. And the best way to follow us and to follow all the updates for the mortgage implementation is to follow us on LinkedIn. The QR code for that is there at the bottom of this slide. I want to thank our guest speakers and our registrants and attendees. So thank you all for spending time today. We'll be sharing these slides and answering some questions via email, so expect that to come over the next few days. Please also fill out the feedback form that you'll see as you depart from the webinar. Thank you all for your time again, and we'll see you next month.